better understand how the prohibited transaction works, I think it's very helpful to look at some examples. So the prohibited transactions are outlined in Internal Revenue Code section 4975, and they apply to really IRAs and 401ks. And they're designed to make sure that you essentially are not using your IRA or 401k funds in any way that personally benefits you or your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities associated with such persons. And that's really the core impetus of the rules, is really to make sure that if you are going to do anything that personally benefits you or your lineal descendants, that you're going to pay tax and take a distribution if you have a pre-tax IRA. That's the goal. The IRS wants to protect the distribution rules. So let's look at the 7 or so categories of prohibited transactions and do a couple examples in each one, so everyone gets a better idea of kind of how it works. So C1A, 4975 C1A says the direct or indirect sale, exchange, or leasing of property between an IRA and a disqualified person. I mean, this is pretty obvious. Don't sell your home that your IRA owns to your dad, okay? This is pretty simple. Most people that do prohibited transactions, they're not screwing up with the easy ones like A, B, and C, which we'll get to. They're screwing up under D, E, and F, which are more catch-all and broader and really tackle a lot of the gray areas, which people get confused on. So I'm gonna briefly go through A, B, and C. I just did A. B, the direct or indirect lending of money or other extension of credit between an IRA and a disqualified person. So again, pretty obvious. You know, you take your IRA and lend it to your parents, your children, your spouse, daughter-in-law, son-in-law. You personally guarantee a bank loan for your IRA. You get a credit card for your self-directed IRA. You can't personally guarantee an obligation of your IRA. So this one's pretty obvious. You know, most people don't screw this one up. C, the direct or indirect furnishing of goods, services, or facilities between an IRA and a disqualified person. So again, this doesn't really, you know, you can't have your dad be the realtor for your IRA, or your kid be the realtor, or have your father be an investment advisor for your IRA. You should stay away from that. Or have your kid make repairs to your IRA home. Obvious stuff. Hire third parties. Don't get disqualified people involved. Okay, now we're getting to the gray area stuff, the D, E, and F's. D, the direct or indirect transfer to a disqualified person of the income or assets of an IRA. So this, you basically would say, okay, someone's going to invest their IRA into an investment fund and then receive a salary for managing the fund. So in that case, excuse me, the disqualified person is using the IRA to benefit themselves personally. So another example, you buy an apartment and you let your child use it. You purchase a vacation home and you stay in it. So, you know, stuff like that, where it may not be direct, but it's indirect because that benefit is there on the other side. So now E and F are the self-dealing and conflict of interest ones that, you know, the IRS seems to really use as a catch-all to really capture transactions that they feel their intent was not in line with what the prohibited transaction rules were intended to stop. So E, the direct or indirect act by a disqualified person who is a fiduciary, where he or she deals with the income or assets of the IRA in his or her own interest or his or own account. So let's take an example. Someone uses their IRA to invest in a partnership with them personally, in which the IRA family member owns more than 50% of. You invest your IRA in a trust where your wife gets a personal benefit from. Use your IRA to lend money to a business which you control. So this is the indirect stuff, kind of like this Rollins v. Commissioner case, which is it's a case I always get to, and I like to share it with people because it gives you an idea of where the IRS is going with this stuff. So this guy, Mr. Rollins, was an accountant. He owned less than 10% of an entity. The entity didn't need money, and that's a salient fact. He was a director, not an employee, and he took his 401k and lent it to the company at prevailing interest rates. The IRS argued prohibited transaction, and the tax court agreed. And they said Rollins couldn't prove that money directly or indirectly didn't personally benefit him. Probably did. If he didn't do that loan, maybe his personal investment goes belly up. So that's kind of, and the court used E as one of the, D, E, and F as a reason why it blew up the transaction. because they felt it was done to personally benefit him and not the IRA. So keep that in mind. F talks about conflict of interest, and 4975C1F talks about receipt of any consideration by a disqualified person who is a fiduciary for his or her own account from any party dealing with the IRA in connection with the transaction involving income or assets of the IRA. So basically, what they're trying to say is you take, let's give you an example. Let's say I use my IRA to invest in a business because the business said, Adam, if you want to secure a job with this business, you have to invest 50 grand, and I'm taking my IRA and investing the 50 grand to secure that promotion. Or my boss goes to me, hey, the company's going bankrupt. If you want to keep your job, you got to invest in the business to keep it afloat, and I use my IRA to invest. There, I'm not making the investment to benefit my IRA. I'm making the investment to benefit me. I probably would not make that investment if I wasn't involved in that company. So that's what the IRS is trying to stop. Those are the privilege transaction rules. That's it. So the first three are easy, right? You just don't do any sale or exchange, no services, no lending. And then D, E, and F are a little bit more complex. You got to get into self-dealing, conflict of interest, and basically you need to consider that if you're doing an investment and there's a disqualified person involved, or someone else is really, other than you, a lineal descendant is personally benefiting, and if the IRS knocked on your door, you would have a tough time defending that deal, because ultimately the reason you're doing it is to personally benefit yourself or a lineal descendant. Don't do it. Simple as that. Don't do the deal. There's other transactions you can do. Buy Apple stock. I don't care. Privilege transactions, the IRS is dead serious about this stuff. I've seen them blow IRA accounts up for $500. They will do it to you. So if there's any question mark, do not do it. Maybe I'm overly conservative. I've had competitors, let people do things that I think is crazy. But I'm going to tell you my principles. My goal is to keep my clients safe. I don't make enough money. You're not giving me enough money for me to tell you to do something which I think is illegal. So I'm not going to let you do that. I take this stuff very seriously, and it's very important that you do as well.